Good evening, viewers. Good evening, Pankaj. Welcome to Market Wrap. A big day for us as Nifty has touched all-time high of 21,000 today. What is your view for the Nifty in the near future? What are the next big levels that you are seeing?
So hi, good afternoon, Dimple. So we all know that Nifty has touched 21,000 today. I think we have already seen a rally of more than 1,000 points, and post this rally, some bit of a profit-taking consolidation at around 21,000 levels is what we would expect. But our sense is that supports are placed at about 20,500 kind of a level, and the next target, what we are looking for Nifty is about 21,400 kind of a levels. And we've seen a very good week for Nifty, with the Nifty gaining 3.3%. Mid caps, small caps also did well. So compared to global markets, we did exceptionally well. Obviously, buoyed by the fact that the election outcome had a big positive surprise on the markets. And apart from that, another positive which is also sort of turning out is that the crude is turning soft. We've seen US yields sort of declining. So it's a confluence of positive factors which is sort of helping the markets. So near-term consolidation correction can pan out, but our sense is that Nifty is headed towards 21,400 in the near term, and possibly we would look to revise our target towards this year or this month end for the next year. So hopefully I'll come up with a much higher levels for Nifty for next year.
Right. But as of now, you mentioned 21,400 and we are all happy about it. Okay, so today RBI has kept repo rate unchanged. Was this in line with the market expectations?
Well, yes, I think RBI event was largely a sort of a non-event because most of the expectations were in line. Like expected, the repo rate was kept unchanged at 6.5%. Since last quarter, GDP growth numbers were good, so there was an expectation that the RBI will revise. So they have revised it from 6.5 to 7% and largely because the domestic use are still good, while globally you are still seeing turmoil in bits and pieces. I think a good part is that they're maintaining the inflation forecast of 5.4 for FY24, although last reading was below 5%. So I think overall, largely they've maintained on expected lines. I think what is important going forward is one needs to see what happens to the bond market next year, because 2024 would be the year where there is an expectation that the Europe will cut interest rates. Even the US is expected to cut interest rates by about 100 bips in the first half. And how are we sort of placing ourselves is what remains to be seen. But I think another perspective is that we have started seeing yields declining in US. So 10-year yield is some bips from the highs. So our sense is that you'll see a lot more excitement in the bond market going forward, and that could have positive implications for banks domestically. One, I think you could see higher inflows because dollar has started to sort of decline, and obviously it could lead to some treasury gains.
I think we've lost you. Hello. Hi, viewers. We sincerely apologize for the technical error. Let's continue. So crude oil is trading at, what would be the impact on the oil marketing companies as per you?
So, Dimple, if you look at crude has corrected from upwards of $90 to $75 now, and this is a very positive scenario for oil marketing companies, because when you sort of look at, there are two positives for oil marketing companies. One, when you look at GRMs, which is one of their business streams, GRMs continue to be very good because companies have been sourcing cheaper crude oil largely from Russia and with good discounts. And so, which is why the premium what they are getting compared to Singapore GRMs historically has been a lot more higher. The other factor which is helping the oil marketing companies is that when you sort of look at, say, last quarter, companies were, say, for example, crude averaged about $89. So that point of time, OMCs were making about 5 rupees on petrol, but were losing about 1.5 rupees on diesel. Now, but when you sort of look at in Q1, the crude oil prices were lower. So that point of time, they were making 8 to 9 rupees each on petrol and diesel. So our sense is that they're going to make good money on the GRM side because crude oil is soft. The other aspect is that on the marketing side, if crude oil prices were higher, they were making losses. But with $75, they're going to make 8 to 9 rupees per liter on both petrol and diesel. 85 rupees, $85 per barrel is the break even for oil marketing companies. And our order of preference would be HPCL followed by BPCL and IOC because HPCL has a higher slate or higher component of refining into their business. So that is the order of preference within the oil marketing companies. But oil companies are definitely in a sweet spot.
Okay, wow. So HPCL is the stock. Okay. Right. So moving on from crude oil to say green stocks, especially looking at Adani Group, it is back in limelight with the stocks becoming very volatile. So how do you see the momentum in these group stocks and any potential stocks that you would recommend from the Adani basket?
So when you look at it from a valuation perspective, some of the stocks are definitely are quite rich in valuations. But still, we have been tracking three stocks within the Adani Group, and we like all three of them. So I'll start with say Adani Ports, largely because when you sort of look at this company, they've got a 25% market share of the port cargo movement. And they have done about 203 million tons in the first half. Their guidance was somewhere about 370 to 390 million tons. So, which our sense is they should be easily able to achieve. The other aspect is that FY25, our sense is that your global trade is going to probably normalize. So, these volumes will sort of further grow from there on. And also, this stock is relatively attractive from a valuation perspective. So it's trading at about 17 times on FY26 earnings. So again, this is an attractive stock according to us. What we also like within Adani Group is both the cement duo, which is ACC and Ambuja. Now, both of them have seen good growth. So ACC delivered about 20% volume growth, Ambuja about 15% volume growth. We have seen EBITDA per ton also improving for both the companies for between last year to now. The EBITDA per ton has improved for both the companies. But what we like more within the cement is ACC because ACC is available at about $100 GE per ton. So valuations are definitely quite attractive. Whereas Ambuja is trading as obviously a rich valuation of $240 per ton. But I think given the fact that the group is quite aggressive on expanding capacity, so they're looking to double their capacity to 140 million tons. I think both the stocks look good and they are also big beneficiaries of the kind of government capex which has been sort of going around. So I think these are the three stocks within the Adani stable which our senses should do well and are looking good from a valuation matrix as well.
Wow. So Adani Ports, yeah, right. Right. Thank you so much for these talks. Next, moving on to real estate. Real estate has given robust sales volume, which have been a key driver for real estate stock outperformance. So, what is your view on these stocks in this segment?
So when you look at real estate as an index, I think this is the only index which has done very well from a last 6 months perspective. It is the index which has given the highest returns. Now, this is largely because when you look at 9-month sales for say top 7 cities, the sales is up about 24 odd %. And this is happening despite the fact that last year base growth growth was about 50% plus. And as a result of the very good growth, what we have seen is that the inventories have come down to say from 32 odd months to say 17 odd months. And but what we are liking more in real estate now is the building material segment because real estate stocks have already done very well. Like I said, I mean the index is already up some 40 plus odd %. But what we are liking in the building phase is that because next 2-3 years or from next year onwards, we'll start seeing the delivery of these houses to sort of happen. So demand for say tiles or something like say for example plywood or wood panel is going to sort of go up. So what we like within that segment is, say for example, Kajaria. Kajaria, we are expecting about 11% kind of a volume growth. So that should lead to a 13% kind of a growth. Margin, which used to be about 13 odd percent, ideally should improve to 16, 17 odd percent. And that should lead to some 20% growth in earnings. So that is another one stock which we like. We also like something like, say, Century Ply. So Century Ply was one of our Mahorot picks as well. This segment or this stock should do well with a revenue expectation growth of about 15 odd percent, because the demand for MDF, which is a cheaper version, or laminate or plywood, is expected to sort of go up. And margin recovery would happen a bit later. So in FY25, margin recovery is expected to happen. But despite all that, our sense is that it should deliver about 20% kind of a return. So we have a target price of 1680 on Kajaria and 750 on Century Ply.
Okay, so Century Ply and Kajaria. Okay, right. Now moving on to another sector, which is sugar stocks. So sugar stocks have fallen substantially as central government directed all sugar mills not to use sugarcane juice or syrup for making ethanol in the 23-24 season, as sugar production was expected to be down this year. So do you think we can enter sugar stocks at this level, or are we expecting a further drop in this sector?
So I think one needs to understand that we have seen a good amount of rally in sugar stocks. A lot of stocks have actually doubled in a very short span of time. Typically, commodity stocks, when they sort of enter into double-digit PE multiples, I think those are very rich multiples for a commodity segment. And which is what has happened with most of the sugar companies, given the fact that they have rallied so much. Now, with government worrying on the inflation aspect in terms of lower sugar cane output, so which is why they are sort of looking to sort of do less of blending and making sugar more available, so that inflation is also managed ahead of elections. So obviously, it is a negative development for sugar stocks. I would not suggest to sort of do bottom fishing or in a situation like this. I think till the time elections are over, because we have a sugar crushing season going on, so a lot will depend in terms of what are the recovery rates and the overall production. Till the time government is not comfortable, they may not allow the higher blending to sort of happen. While structurally blending will go up from 12% to say 20%, which is what government has been saying. But right now, with less diversion, it will come down to single digits. And since ethanol is a high margin segment, so obviously margins will also get impacted. So our sense is that these stocks need to sort of consolidate for some period of time before one can sort of look at having fresh exposure in.
Okay, right. So that is about sugar stocks. I mean, I think we should be keeping away from these stocks for the time being. Okay, now coming to hidden gems. So please let us know the potential stock and the rationale for buying the same.
So I think right now large caps are doing better. Largely, I have been recommending more of mid caps and small caps, but I would want to sort of recommend a large cap. The stock would be IndusInd Bank with a target price of 1,800. Now, the reason why we are liking this stock is that one, overall the credit growth for this stock is expected to be good at about 18.5%. The other thing is that the RBI's recent announcement of 25% risk weightage increase, I think, will have a limited impact on the stock. So we expect over 35 to 40 odd bips kind of an impact on the capital adequacy ratio. Then I think our sense is also that companies' MFI or microfinance portfolio has been sort of stagnant. It's a high yielding book. So the bank has started growing this book again. And other part is that the company's exposure on the auto side has been good. So our sense is that auto as a sector will continue to sort of do well. And on top of it, when you look at it from a valuation perspective, so this stock used to deliver 2%, closer to 2% kind of ROA, and was valued at 2 times adjusted book. But our sense is that with sort of earnings sort of normalizing, it's available at about 1.5 times adjusted book. So it should sort of, the multiples also should get normalized, and which fetches a target of 1800. And also senses that if you get higher inflows, banks are the place to be, because banks are considered to be a proxy for good for economic consumption. And I think IndusInd Bank fits the case from overall perspective. So improvement in valuations, improving fundamentals, plus higher inflows, plus focusing on the right segment. I think these are some of the combinations. So it's firing all the cylinders as of now.
Right. So IndusInd Bank is the hidden gem for this week. Also, I have one or two questions from the viewers. They are asking about the Kotak Mahindra Bank. So your view on this Kotak Mahindra Bank?
So I think when you look at tier 1 bank, say for example Kotak Bank or say HDFC Bank, our preference would be more with HDFC Bank, because in Kotak we have seen the announcement of new management, probably market, or we also need to sort of develop a lot more comfort in terms of how they are going to sort of deliver growth going forward. So that remains a sort of a key variable to be watched out for. I think HDFC Bank, from that perspective, has already seen a decent amount of price correction and time correction and price correction, and is looking to sort of improve the margin, which had fallen from say 4% and I have to say 3.4%. So next 3-4 quarters, they should recoup those margins, and I think ideally it should also benefit from higher FI inflows. So I think HDFC Bank looks better compared to Kotak for the next 1 year. I think Kotak, we probably need to develop or get more confidence in the new management before we would say that it could sort of outperform.
Right. And I have one more question on Apollo Hospitals. What is your view?
I think this hospital as an entire team has done very well. So, which is why, since the price appreciation has been pretty robust across the space, I wouldn't want to sort of recommend fresh into this stock, while the outlook for next say 15-20 years is good, because you will have higher penetration for insurance. You will have higher medical tourism, then the overall new hospitals which have been opened up, as they mature, the margin profile sort of inches up. But a lot of it is there in the prices, so I will wait for some correction to happen before I get into, or I would suggest hospital stocks. So we have recommended some stocks in the past, but I think most of the stocks have run up. So let's wait for some profit taking or consolidation to happen before one can take exposure.
Right. All right. Thank you so much, Pankaj. I hope all the viewers will benefit from this extremely insightful session from Pankaj Pandey, our head research, ICICI Securities. Thank you very much.
Thank you, Dimple, and apologies for the technical glitch which we faced today.
Right.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.